So at a rally this weekend, President Trump decided to threaten raising tariffs on China, which are already at about 10%, all the way up to 25%, more than doubling them. Now this is coming as quite the shock to the equity markets, which have pretty much already priced in a trade deal being done and paid for. The S&P, for example, has rallied about 500 points this year on trade talk optimism. The official line coming out of the White House nearly every day was that we're very close to a deal with China on the trade matter. In other words, the 10% tariff that Trump had put in place would fall down to zero, and there would be some new deal with the Chinese. But instead of that emergency tariff that Trump put in place for negotiating purposes going away, it's actually more than doubling. So that means that the costs of inputs from China that are used in businesses in the United States are going to go up. So it's going to cost them more to produce their goods, and therefore they will make less profit. If you're, I don't know, a shipbuilder or something, and the price of Chinese steel goes up quite a bit, then you're going to be making quite a bit less money. And of course, this will directly impact the price of consumer goods that are imported from China, meaning that every American will be able to purchase less goods with their paycheck. Of course, the foreign exchange markets are doing quite a bit to compensate for the tariffs. The yuan is plunging pretty hard today, meaning that you can buy more yuan for the same amount of dollars, essentially making Chinese goods cheaper. So I don't think that the currency has plunged enough to compensate for the increase in the tariffs, but it'll help offset it a little bit, considering that dollars are now worth more to the Chinese. And of course, dollars will always be quite valuable to the Chinese so long as they have a great deal of dollar-denominated debt like they currently do. The predicament that the Chinese are in is that they have all these loans in their country that are payable only in dollars and not in yuan. So that means that China has to work to earn dollars by exporting to the United States. The reason for this, that all their debt is in dollars, is like many countries, banks do not trust the Chinese not to inflate their currency to pay off their debts. This is why a lot of countries, most countries in fact, when they get international loans from banks, they're pretty much always denominated in dollars because that's something that those countries can't control. Now, banks just pretty much have to trust that the U.S. isn't going to inflate their money. The U.S. is, one of the few countries that actually can issue debt in its own, denominated in its own currency. But since the Chinese don't have that luxury, they're really in a tight spot here. If the United States doesn't run a trade deficit, if we're not exporting dollars, it makes it very difficult for countries like China to be able to make their debt obligations. Meaning that if Trump had the stomach to really take the hit, to take that punch, and allow the stock market to take a big hit from the tariffs, well, then in the long run, he could do a lot of damage to the Chinese economy, assuming it's his goal to really hurt the Chinese. Because even if Trump sends us into a pretty deep, dark recession because of this, trade spat, the Chinese will go into a worse depression. And theoretically, considering that the Chinese government really gets its legitimacy based on their ability to give the people of China a high standard of living, if all of a sudden all of their economic growth goes away and they're in a recession for a prolonged period of time, there is the potential that the communist government could lose its credibility amongst the elites. Though somehow I doubt that Trump's whole trade war with China is really just an elaborate regime change ploy. And so far, it doesn't look like that the Chinese are backing down. They seem to be joining Trump in this brinksmanship routine, and it looks like now that they're going to call off all trade talks in the future, meaning that we're going to end the negotiations with no deal, and what will be the status quo of 25% tariff will remain in place indefinitely. Now, my guess is what the Chinese are betting on here is that Trump is not going to be able to handle the economic repercussions of a 25% tariff for long, and that he will, in fact, buckle. So even though in absolute terms the Chinese are much more susceptible to this trade war and have a lot more to lose, the the U.S., they are assuming, is going to be far less tolerant of any loss. They essentially think that the American people are soft and that their politicians, considering that they're subject to re-election every 4 years and that Trump is up for re-election in 2020, that he will not allow the economy to be in recession by election time. Meaning that the Chinese won't have to default on their dollar-denominated debts because the trade war will have to be over by then. Now, of course, something that I haven't discussed yet is the Fed. And Trump, very out of left field, recently called for the Fed to lower interest rates by 1% and return to QE, meaning quantitative easing, where the Fed just goes out and spends money and they create money out of thin air to purchase assets. Now, Trump's plan might be, in this case, that if he's going to put this 25% tariff on China, he's going to try and offset the economic damage by just having the Fed print as much money as possible and just really go all in on QE4. Now, this sounds incredibly reckless to me, because it's not like QE can create real economic growth. So if you conduct one policy by creating real economic destruction, and then you offset that with something like quantitative easing, which is essentially the opiate of the markets, then you're not really offsetting anything. You're just giving the market a painkiller. Of course, the Fed will have a lot of room to conduct monetary policy and just print money if the Chinese yuan keeps falling the way that it is, because the dollar is strengthening. However, the fall in the yuan is really cutting into the effectiveness of the tariffs. So then if the Fed decides to print money because the dollar is rising, I know this sounds a little confusing, but bear with me. If the Fed decides to print more money, since the dollar is rising anyway, essentially they're saying, well, we won't be devaluing the dollar. Well, then what they're doing essentially is they're raising the tariff on Chinese goods, which may in fact do more damage to the economy than QE will be able to cover up. This is a very difficult situation, considering that the Fed is supposedly not supposed to coordinate directly with the President of the United States, since they're supposed to be apolitical. But the only way that any of this works out is if they collude directly with President Trump on how they're going to handle this matter. And of course, there's one last player here that needs to be mentioned, and that's Steve Mnuchin. Steve Mnuchin is the man who saved the markets back on Christmas Eve when he called the Plunge Protection Team. The Plunge Protection Team essentially is supposed to buy stocks and prop up equity prices when things seem to be falling off a cliff. Now, of course, that's direct market manipulation. People like to talk about blah blah free market capitalism. Yeah. Not in America. There's nothing free about a market that isn't allowed to go down. That's no different from the Chinese stock market, where I believe in 2008 the Chinese put short sellers in prison, meaning people who were betting against the market going up, people who were making bets that the market would fall more, which of course they were correct. So the Plunge Protection Team will likely be assembled in the White House here in the coming weeks if things don't de-escalate very quickly. It's very odd living in this new era where stocks are just not allowed to go down. It's just an anathema. It can't possibly happen. I mean, it just needs to go straight up until, I guess, at least until the election. Maybe they'll be allowed to fall during Trump's second term, but I don't know really. We're definitely in uncharted waters in many different respects. So as I sit here, U.S. equity stock futures are down about 2% across every index, and Chinese stocks are down about 6% last I checked. So I will keep an eye on this. So if you gained anything of value out of this video, I'd appreciate you clicking that like button and subscribing. And if you do subscribe, please do click the bell, because I do upload every day, and I'd hate to have you miss one. So I'll see you folks back here tomorrow.